Welcome back to the e-learning core 3, Fixed Income Analysis, session 1.3. In this session, we introduce the yield to maturity, which is another important concept in bond valuation. The learning goal of this session is that you understand the concept of yield to maturity as the standard measure of the total rate of return of a bond investment. The yield to maturity is defined as the interest rate that makes the present value of a bond's payment equal to its price. You can think of this interest rate as the average rate of return that will be earned on a bond if you buy the bond now and hold it until maturity, and assuming that all coupon payments can be reinvested at that particular yield. In order to obtain the yield to maturity, we have to solve the bond pricing formula introduced in session 1.2 of this course for y. Another interpretation of the yield to maturity is the discount rate that investors use to price the bond. Since bond prices, like all other asset prices, are determined by supply and demand on a market, the yield to maturity is the interest rate that makes the present value of the bond's cash flows equal to its current market price. The computation of the yield to maturity is based on iterative procedures and can be easily done in Excel or other spreadsheet programs. The built-in Excel formula for computing the yield to maturity is simply yield and follows the syntax depicted in the figure on the left-hand side. The Excel formula requires a settlement date, a maturity date, an annual coupon rate, a bond price, the redemption value in percentage of the face value, as well as the coupon payments per year. Let's have a look at a concrete example. Consider a bond with 30 years to maturity and an 8% coupon rate where coupons are paid semi-annually. The current price of the bond is $1,276.76. Substituting in these numbers in the bond pricing formula and solving for y implies a yield to maturity of 3% per half year. It follows that the bond equivalent yield is 6%. However, if we account for compound interest and compute the effective annual yield, we obtained an annual yield to maturity of 6.09%. It is important to distinguish the yield to maturity from the current yield. As we know by now, the yield to maturity can be considered as the bond's internal rate of return. In other words, the yield to maturity is the interest rate at which the present value of a bond's payments is equal to its price. However, the current yield is simply the bond's annual coupon payments divided by the bond price. For premium bonds, which are bonds selling above par, the coupon rate is greater than the current yield, which in turn exceeds the yield to maturity. On the contrary, for discount bonds, which are bonds selling below par, these relationships are reversed, which implies the yield to maturity is above the current yield. Related to the previous example, where the coupon rate was 8% and the bond was selling above par, the coupon rate is greater than the current yield and the yield to maturity. You can think about buying a bond above par implies a capital loss if you hold the bond until maturity, since the final payment corresponds to the bond's face value. The yield to maturity accounts for this built-in capital loss on the premium bond. We have seen that the relationship between bond prices and interest rates is inverse, meaning if interest rates decrease, the price of a bond, which equals the present value of the promised payments, can rise substantially. A callable bond is a bond that consists of a call option, which gives the issuer the right but not the obligation to repurchase the bond before maturity at the call price. If interest rates are very low, the price of the callable bond is flat, meaning that the risk of a repurchase is high. If interest rates in the economy are high, the issuer of the bond has no real incentive to call the bond, and thus the price of a callable bond converges to that of a straight bond. Let's have a look at an example. Suppose an 8% coupon bond with a maturity of 30 years and semi-annual coupon payments sells for $1,150 and is callable in 10 years at a call price of $1,100. In order to calculate the yield to maturity and the yield to call, we use the following inputs. The yield to call as well as the yield to maturity can be calculated very easily in Excel using the inbuilt formula yield. Note that in the context of computing the yield to call, the redemption value is 110% of the par value. Doing these computations gives a yield to call of 6.64% and a yield to maturity of 6.82%. As discussed before, the yield to maturity is a measure for the benefit of investing in a bond. You can think of it like the internal rate of return of an investment project in corporate finance. However, to maturity implies we consider the return from today to maturity under the assumption that coupon payments are reinvested at an interest rate equal to the yield to maturity, while the realized return will be known only after maturity. Let's illustrate this with an example. Consider a 2-year bond which sells at par. The coupon rate of 10% is paid once a year, and the par value of the bond is $1,000. Based on these assumptions, it follows that the yield to maturity is equal to the coupon rate of 10%. If all coupon payments of $100 are reinvested at an interest rate equal to the bond's yield to maturity, the yield to maturity will equal the realized yield. This can also be seen from a future value computation. If we reinvest the coupon payment obtained at the end of year 1 at the rate of 10%, we will get an amount of $110 at the end of year 2. Together with the cash flow received in year 2, consisting of the coupon payment of $100 and the repayment of the face value of $1,000, the bond investors receive a total cash flow of $1,210, which implies a realized return of 10%. On the previous slide, we've assumed that coupon payments can be reinvested at the yield to maturity. But now, let's assume that the 1-year interest rate after 1 year will drop to 8%. This means that after a 2-year period, we would receive only $1,208, and the realized yield would be below the yield to maturity. This allows us to draw the conclusion: in an economy with future interest rate uncertainty, the rates at which interim coupons will be reinvested are not yet known, and therefore the realized yield is not known until after maturity. After having carefully studied session 1.3, please start with the review questions.